Okay, hello everyone. So in today's class, we are going to attempt a past paper question from September-December 24 attempt. And the past paper of this September-December 24 attempt covered investment appraisal as well as a working capital management question. So you will get good preparation. I usually advise students not to directly watch these past paper videos. These are for your help, obviously. That's why we have uploaded them on LMS. But the first good thing is that when you open this past paper, you should first attempt the question on your own and then watch the video to ensure you find that whether you were right or wrong. Okay. The first question, the scenario relates to three requirements. Okay. There are three requirements. Galle company is a company which manufactures car batteries. Its latest project is a new battery called G Power XL GPE, which is a variation on an existing battery but uses less harmful materials in its construction. Due to technological advances, the GPE is expected to life of 4 years. Okay. So it's a company which manufactures car batteries. Latest project is the new battery called G Power XL GP. It's a variation of an existing battery, uses less harmful materials. Due to technological advances, GP is expected to have a life of 4 years. Sales for the first year are expected to be 10,000 units, okay? But the remaining 3 years are more uncertain due to the risk of similar products being launched by competitors. Gal expects that the sales volume will remain constant at 10,000 units per year for the final 3 years, but there is a 30% probability that volume could drop to only 5,000 units for the next 2, 3, and 4 years. Something interesting. Sales for the first year are expected to be 10,000 units. So in year one, it's 10,000 units. It's fine. Remaining 3 years are uncertain. Gal expects sales volume will remain constant at 10,000 units per year for the final 3 years. In the year 2, 3, 4, it can 10,000 units for the final 3 years. But there is a 30% probability that volume could drop to only 5,000 units per year in year 2, 3, and 4. So for year 2, 3, 4, volume can be 5,000 units. We must catch here that for year 2, 3, 4, it's saying that there is a 30% probability that volume can be 5,000 units. Okay. There is a 30% probability that volume can be 5,000 units for year 2, 3, 4. That means there is a 70% probability that the volume will remain at 10,000 units. Okay. So this is the first thing you must catch here. Okay. That sales for the first year are expected to be 10,000 units. So I have no problem in the first year that it's going to be 10,000 units. But the remaining 3 years are more uncertain due to risk of similar products being launched by competitors. Gal expects that sales volume will remain constant at 10,000 units per year for the final 3 years. So for the final 3 years, it will remain at 10,000. But there is a 30% chance that volume will be 5,000 units per year. So 70% probability that it will be 10,000. 30% probability is 5,000. So where did you get 70%? I've taught you multiple times in the classes that if 30% probability of 5,000, then there is 70% probability of some other 10,000 units. And when units and probability are given, we immediately find EV. This is what is taught to you, okay? That when units and probability are given, immediately EV, 5,000 units, 0.3 probability, EV is 1,500, 10,000 units, 0.7 probability, EV is 7,000. So total EV is going to be 8,500 units. This is for year 2, 3, 4 only, because for year 1, it's 10,000 units. Remaining 3 years are uncertain, so sales volume will be 10,000 units per year for the final 3 years, but 30% probability that it will be 5,000 units per year for year 2, 3, 4. Okay. So many people might have missed that in the question in this second paragraph that sales will be 10,000 units. Okay. And first year and remaining 3 years, it will be 10,000 units, but 30% chance that will be 5,000 units. That means 70% chance of 10,000 units. So you find EV. GP is a selling price in current price terms of 70 per unit. Sales price will be inflation 4.5% per year. Variable cost is 4.5 per unit in 45 in current price terms. Variable cost will be 3% per year. Fixed cost inflation, constant 30,000, 10,000 units per $10,000 per year. Manufacturing equipment costing 500,000 will be purchased at the start of the first year. Equipment will qualify for tax allowable depreciation. Capital allowance is 25% RDB. And equipment will have zero scrap value at the end of 4 years. Working capital of 80,000 will be required at the start of the first year, and working capital inflation will be 3% per year. Working capital needs to be in place at the start of the year to which it relates, will be released at the end. Everything normal. Galle pays tax at a rate of 20%. Taxes paid at the end of the year in which it relates. Taxes paid at the end of the year, same year, not next year, in years, at the end of the year in which it relates. Galle is profitable, can utilize any unused tax allowable depreciation. Galle has a nominal after-tax cost of capital of 13%. You know that when there is inflation, we use nominal cost of capital. So it's given for the GP project, calculate the expected NPV. So, I have taught you this in class, expected NPV. That means it must involve EV. Expected NPV, it must involve EV. That's why it's expected NPV, because it's involving EV. Okay. And then 2 marks comment on its financial acceptability. So let's start finding the NPV. Okay. Now, firstly, you know that we are operating a standard pattern that first what we do is to make a capital allowance schedule. And in capital allowance schedule, we have here the capital allowance and the tax saving. Tax savings. What is the tax rate? 20%. Okay, so let's make a capital allowance schedule first, which has been our normal strategy in every NPV question. So there is 4-year life. So 1, 2, 3, 4. Capital allowance is 25% reducing balance. So 500,000 is the cost and 25%. Okay. Then net book value remains 375,000 and you pay 25%. Okay. Then net book value 25%. Okay. And in the last year, what is the net book value? So net book value is 500,000 cost minus accumulated depreciation. That's B7, B8, B9. This is the net book value. Okay. So 210937. This is the net book value. This should have been charged. Okay. Since this is the last year, everything full value should be charged. Okay. But we received scrap 0. Okay. So take the difference of scrap 0. It will be the same value. Okay, we don't apply 25% on that because the full value will be charged whatever is left in the last year. Remember? Then in the last year, whatever the net book value is left, we fully charge it, excluding the scrap value. Okay. Now tax savings at 20%. So it's B7 into 0.2. It's going to come in the same year and we will drag it. Okay. So this is the capital allowance schedule we have made. Now, once you are done with the capital allowance schedule, we will start calculating the NPV. Okay, once we move towards the capital allowance schedule, we will start computing the NPV. Okay, so for NPV, let's start from here. That it's a 4-year life, sorry. So 0, 1, 2, 3, and 4. So I've made a table and now I'm going to write all values. I will start from investment. What is the investment? It's negative 500. Okay. Then I start with revenue, variable cost, fixed cost. So I think since it's inflation, so it's better to show it somewhere in the workings. Fixed cost won't require any workings because it's constant at 10,000. Okay. So let's just start doing it here. So firstly, the revenue is going to come. units. So in the first year, units are 10,000. And in year 2, 3, 4, it's 10,000, but 30% probability to be 5,000. So we computed 8,500 EV. And we have a selling price figure as well, right? I'm just adjusting it to ensure that it comes in the correct space and doesn't disturb you and you get everything on the same screen. Obviously, in examination, you don't have to worry about that. Okay. So selling price. I'm seeing the selling price is 17 current price terms. Current means zero terms and it's inflating at 4.5% per year. So 70 inflating at 4.5% per year. Okay, it's 73.15. Then inflating at 4.5% per year. So B 14. So we have the selling price, we have the units. You will get the revenue by multiplying selling price with the units. So B14, steric, B13. You get the revenue. Okay. And you also have variable cost. So variable cost is 45 per unit in current price terms. It's inflating at 3% per year. So in year one, it's going to inflate by 3%. And in year two, it's going to inflate by 3%. I will just drag it. I have the variable cost in the units, so negative sign. Variable cost per unit is B15 into B13. We drag it. Fixed cost is going to remain constant at 10,000 per year. So minus 10,000, minus 10,000, minus 10,000, minus 10,000. Okay. So revenue less variable cost, less fixed cost. You end up at taxable profit. So it's the sum of K5 to K7. And on that taxable profit, we have to pay tax same year, 20%. So I applied tax 20% on the taxable profit K8 into 0.2. It has to be negative and dragged it. And now you know that after paying tax, we have issues like working capital investment and the working capital recovery. Then we have scrap value, which is not there. And then finally, tax savings from capital allowances. So tax saving from capital allowances will be copy pasted here. That it's C7. C8, C9, C10. So I think after that we get net cash flows. So scrap value is not there. So the only thing left is working capital investment and recovery. And I will refer it in working 3. So you can mark the titles that this is working 1, this is working 2, this is working 3. Okay, now working capital is 80,000 at the start of first year. Okay, so at the start of first year means end of year zero. Okay, so at the start of first year it's 80,000. So that means at the end of year zero it's 80,000. And then it's increasing, inflating by 3% per year. So that means in year one it's going to inflate by 3%, become 82,400. And this will increase by 3%, 3%. Okay. So working capital is basically 80,000 at the start of year one. So you put it in 080. Then it will be increasing by 3% per year. So that means at the start of year two, end of year one, it's 82,400. So 80,000 is already injected. You will put 2,400. Okay. Then N will further increase to 84872 uh, at the start of year three. So that means at the end of year two, you have to put the difference of 84872. But we have already put 80,000 as well as 2,400. Make it negative. Okay. Then at the start of year four, that means at the end of year three, 87418 is required. That's the 16. But you have already put what? 80,000, 2,400, and 2,472. Okay. Don't put anything further than the last year because last year is recovery. So whatever you have injected, you will recover it in the last year. So you put 80,000, then put 2,400, then put 2,472, and then put 2,546. All this is recovered in the last year. So, in my opinion, up till now, there is no difficulty or technicality in the question. Investment return, revenue, selling price into units, variable cost into units, fixed cost, taxable profit, tax, working capital, very easy. 80,000 is required at the start of first year, so you put it in year zero. Then it's inflating by 3%, so 82,400, then 84,872. So whatever is the increment, we invest that. Then recover in the last year, then tax from capital allowances. So all in all, it will get net off and give you net cash flows. I'm moving towards the net cash flows figure now. I get the net cash flows. Now, after net cash flows, the discount factor is 13%. You can write discount factor 13% from the tables, multiply them to get present value net of NPV, or you can use the NPV function for this. We have taught you NPV function that it's equals to NPV bracket open discount rate, that's 13%, comma NCF from year one to last, that is K13 to N13 plus NCF of year zero, that's J13. You get the NPV as 14639 positive. You're not expected to comment in this part because it's just calculate the NPV. Comment on its acceptability is the second part. Okay. So I want you to first copy and then we will write it. Okay. It is a good question. Easy mark scoring question. Now the second requirement here was comment on its financial acceptability. So since NPV is a positive, project is financially acceptable, right? You get 1 mark for that. But since there is some uncertainty involved in last 3 years, it is important that risk and uncertainty techniques are applied to reach a more informed decision. Okay. So obviously, had it been 1 mark, we would have just written that since NPV is positive, project is financially acceptable. Okay, but it's 2 marks, so I have to add something from myself. So I just catched a point that there are some uncertainties involved in year 2 and year 3. It's better that you consider risk uncertainty techniques to reach a more informed decision. We have done the 12-mark requirement. Please copy this so that we can move forward. Okay, so we are done with this portion. Now let's move towards the next portion. Discuss 4 techniques for dealing with risk and uncertainty in investment appraisal. So there are 4 techniques of dealing with risk and uncertainty in investment appraisal. The first technique is probability analysis. The second technique is sensitivity analysis. Many people only remember these 2 techniques of dealing with the risk and uncertainty. Then there's a third technique, simulation and risk adjusted, or what you call WAC, or you can write capital asset pricing model. You remember in capital asset pricing model, we incorporate risk by ungearing, regearing. So these are the 4 techniques of dealing with risk and uncertainty. Now, writing just names will give you 2 marks out of 8. 0.5, 0.5, 0.5, 0.5. So don't just write the names, you have to explain them. And the explanation is written in the class. Probability analysis, the explanation is written in the class. This technique incorporates risk by converting different possible outcomes into one single expected outcome called EV, expected value, and decision is then taken on EV, right? However, finding probabilities may be difficult. Even if you don't write this, it's nothing problem. Okay. So probability analysis has been explained that this technique incorporates risk by converting different outcomes into one single expected outcome called EV. Decision is then taken on the basis of EV. Sensitivity analysis, I've written this. I think there was a question in the class of SC company or duo company in which this requirement was also there. This technique incorporates by finding the maximum limit to which any variable can fluctuate. If company knows in advance the maximum limit to which a variable can fluctuate, it ensures that variable does not go beyond that limit. Third technique, simulation. Simulation is a computer-based model and is a more, or you can say, has an advantage over sensitivity analysis, that it allows more than one variable to change at a time. Using computer based models helps in identifying and minimizing risk, but it's very, very time consuming. Okay, in the theory classes on your LMS, we have studied the book reading and their simulation was covered. Remember, simulations calculation is not examinable. That's why you never face simulation calculation in the exam. But simulation theory can be tested. Simulation is a computer model where you put random numbers and the computer decides the risk-based variables and how to minimize them. And it can be said as a more better version of sensitivity analysis because in sensitivity analysis, only one variable can change at a time. You cannot perform sensitivity analysis on sales, variable cost, fixed cost together. Remember, I have taught you to perform sensitivity analysis on sales separately, variable cost separately, NP over present value of sales, NP over present value of variable cost, NP over present value of fixed cost. We have not performed sensitivity of all variables changing together. Okay. Simulation does allow multiple variables to change together. Therefore, it has an advantage. Okay. Now, finally, is risk adjusted WACC. This technique incorporates risk by finding a new WACC where if a project has higher risk, discount rate should be increased to compensate for increased risk. And if project has low risk, discount rate shall be lowered. You know, ungearing, regearing, I taught you that if the risk is high, we ungear, regear to get a higher discount rate. And if risk is low, the beta is low, reduced risk, reduced cost of capital. Okay. So these are the 4 techniques which you can write them and get 8 marks. It was a very easy 20-mark question. Please copy this. Okay, so let's move towards the second question now of this September-December 24 attempt. It relates to working capital. It's a very good question and a mark scoring question as well. This scenario relates to 4 requirements. Guillermo is a medium-sized company that manufactures a single product. Product should only take 2 days to manufacture. 2 days is the manufacturing period. Figures from its most recent financial statements are revenue 6 million, raw material inventory 120,000, work in progress inventory 20,000, finished goods inventory 80,000, receivables trade 850,000, trade payables 162. So you have been given raw material inventory, work in progress, finished goods inventory, receivables and payables. Sales. Credit sales account for 75% of revenue. So revenue is 6,000. Credit sales 75% of revenue, so 0.75, 6,000. Credit sales. Gross profit margin is 60%. So if gross profit margin is 60%, gross profit margin is 60%. 60% of what? Sales. So that means what will be the 40%? That will be cost of sales. If 60% is the GP margin, so cost of sales would be 40%, right? Getting it? Revenue 6,000. 75% is the credit sales. So 75% credit sales. Gross profit margin 60%. So gross profit is 60% of sales. Or margin is always on sales. 60% of 6,000. So the remaining 40% is cost of sales. Guillermo has a large number of credit customers, but there is no separate credit control function. Chasing of overdue debt is left to relevant customer account manager. Finance manager considers this to be satisfactory to enable the finance department to concentrate on more important aspects of the business. Standard credit terms for customers are 30 days. No credit accounts are currently suspended. Okay. All customers, account managers are paid a bonus based on level of sales achieved. So this is all information about sales that Guillermo has a large number of credit customers. There is no separate credit control function. Chasing of debt is left to relevant account manager. Finance manager thinks it's satisfactory. Terms of credit are 30 days. No accounts are suspended. All customer account managers are paid a bonus based on sales. Purchases. Raw material purchase in the year total 2,160,000. 90% was purchased on credit. So purchases, it's 2,160. Okay. And credit purchases, 90% of 2,160. Okay. Raw material is the only supply Guillermo could purchase on credit. So raw material can be purchased on credit. Guillermo has always tried to maintain good relations and the average credit term from suppliers is 35 days. Okay. Cash management. Management of Guillermo has decided it wishes to minimum cash balance of 40,000 and cash balance is volatile with a daily standard deviation of 15,000. So minimum cash balance 40,000. Volatility of deviation is 15,000. If extra cash is needed, Guillermo will sell securities from an investment portfolio to owns. Transaction cost for a purchase is the same as for sale at 55 per transaction. So transaction cost is 55 per transaction. If cash is needed, it will sell security. Interest rates are 9% per year. Assume a 360-day year for all calculations. So a year is 360. Okay. Requirement A 5 marks, calculate cash operating cycle. Now you know that if you want to find cash operating cycle. So I have taught you cash operating cycle for two businesses, retail business, manufacturing business. Okay. Retail business is finished good, stock holding period, plus debtor collection period minus creditor payment period. This is for a retail business, finished goods stock holding period, debtor collection period, and creditor payment period. But this is a manufacturing company, right? It manufactures a product. So for manufacturing sector, it's raw material, stock holding period, add WIP period, add finished goods stock holding period, add debtor collection period, less creditor payment period. So you get cash operating cycle. Even if you didn't catch here that it's a manufacturing company, still you must know that since raw material, WIP, finished goods is given, so you need to have a cash operating cycle via this formula: raw material stock holding period plus WIP period plus finished good period plus debtor period less creditor payment period. And if you catch it here, it's good. Otherwise, it's a manufacturing company. So cash operating cycle for manufacturing is raw material stock holding period plus WIP period plus finished goods stock holding period plus debtor period less creditor payment period. Now I will compute everything here. So for raw material stock holding period, you know that it's average raw material stock. So average raw material stock is, or you can compute it, I think, directly. So it's average raw material stock. So what is the average raw material stock? It's 120 divided by purchases. Remember, average raw material stock divided by purchases into 360. Now, some people may argue that you taught us the formula of raw material stock holding period as raw material stock 120 divided by material usage. I did taught you. But I also taught you that if usage is not given, we use purchase. Okay. So raw material stock divided by material usage. If it's not given, it's purchase 2160. I didn't write credit purchase. I only wrote purchase, right? So average raw material stock divided by material usage or purchase into 360. Raw material stock holding period 20 days. Okay. Then the second thing is WIP period. So for this WIP stock, that is 20 divided by, what was that? Average WIP stock divided by production. Average WIP stock divided by production. And I told you if production is not given, you can take cost of goods sold. 2400 into 360. Okay. Finished goods stock holding period. Average finished goods stock 80. So finished goods stock holding period or inventory holding period is inventory upon cost of goods sold. So cost of goods sold is 2400 into 365. Okay. Then debtor collection period, it's straight debtors 850 divided by not sales, credit sales 4500 into 360. Okay. And the creditor payment period is trade creditors, that's 162, divided by credit purchases. And if it's not given, cost of goods sold. So credit purchase is given 1944 into 360. Okay. So the only thing that matters here is cash operating cycle. It will be adding all and then deducting. So sum of B11 to B15 will give me cash operating cycle of 73 days. So the only thing is formulas: raw material stock holding period, raw material stock 120 divided by material usage. And I taught you if usage is not given, I took purchase, not credit purchase, purchase to 160 into 360. WIP period, average WIP stock divided by production cost. And if production cost is not given, cost of sales 2400 into 360. Finished goods stock holding period is average finished goods stock 80 over cost of goods sold into 365. I wrote mistakenly 365, it's 360. Okay. Debtor collection period, debtors upon credit sales 4500. Make sure you don't take revenue, take credit sales. And its creditor payment period is trade creditors upon credit purchases into 360. 73 days. Okay. So 5 marks, very easy marks. Please copy this. Okay, now let's move towards the next part. Discuss 3 ways in which Guillermo could reduce its cash operating cycle. 6 marks, 3 ways in which cash operating cycle can be reduced. So you see that in the previous part, cash operating cycle was 73 days. So it's asking 3 ways in which cash operating cycle can be reduced. Okay, so there are normal 3 ways to reduce cash operating cycle. Number 1, reduce the holding period of stock, or reduce the WIP period, reduce the debtor collection period, or increase the creditor payment period. There are 3 ways, right, to reduce the cash operating cycle, okay, or to improve working capital management. Reduce the holding period. If you reduce these holding periods, the operating cycle will get reduced. Or reduce the debtor collection period from 68 days to less, the cash operating cycle will fall. Or increase the payment period. If the payment period gets increased, more negative thing, like in case of minus 30, I write minus 40C. If we increase it, it will be reduced. Okay. So there are 3 ways. So I will just write them and explain them, obviously. Reduce stock holding period. 2 marks per point for 6 marks. So you need a bit of explanation. Both raw material stock holding period and finished goods stock holding period are high. If company is able to sell stock quickly or keep raw material for less number of days, the cash operating cycle can be reduced. Okay. Second way is reduce debtor collection period. The debtor collection period is 68 days, which is high. If it is reduced, cash operating cycle can fall. Now, here is the thing where examiner feels that the student is just writing general points. He's not linking to the scenario. I wrote correctly in raw material stock holding period and finished goods stock holding period that they are high. If you are able to sell stock quickly, keep raw materials for less number of days, the cash operating cycle can be reduced. It was fine. Why? Because nothing was mentioned in the scenario with respect to this. Why point number one is right? Because I wrote generally and point number two is wrong, even though I wrote that as generally. Thing is that there was nothing mentioned about stocks in the question. But here it clearly mentioned that the standard terms for credit for customers is 30 days. Okay. So you can write the standard credit terms are 30 days, but company is recovering money in 68 days, which means recovery department or person responsible is not doing a good job. Okay. Even though it was just 2 marks, that's why I stopped here. Otherwise, I could have elaborated more. And this is the art of writing, that if you think there are 4 or 5 marks, you can elaborate it further, right? Like it says, all customer managers are paid a bonus on level of sales. So customer managers who are responsible for chasing debt, they are given bonus for high level of sales. So their only interest is making more sales to get bonus, and they are not interested in chasing debts, which is evident. This can result in bad debts. So all these stuff is provided by the question. It's just that I have to pick it from my own mind. Okay. And these things you cannot get from the book. Many people say, okay, we read the book, then our theory gets improved. No, this is something you need to create it from your mind from scenario linking. Obviously, if nothing was mentioned in the question, I would have just randomly written and went away. But if something is mentioned, make sure you just give an idea about that so that examiner feels he's involving in the scenario. Okay. And the third thing is increase creditor payment period. If company is able to take more time from suppliers for payment, the cash operating cycle can be reduced. Again, there is something mentioned in the question that credit term from suppliers is 35 days. And what you're doing, you're paying in 30 days. So you can make this till 35 days and fall, your cash operating cycle can be reduced. Okay. So suppliers are allowing 35 days and we are paying in 30 days. So if we increase it by 5 days, cash operating cycle can fall. This is good 6 marks. Okay, please copy this. Okay, using the Miller-Orr model, calculate the target cash balance for Guillermo. So using Miller-Orr model, I need to find target cash balance. Okay, so a student might get worried in this 3 mark requirement that it's asked using the Miller-Orr model, calculate the target cash balance. So in Miller-Orr model, I was never taught target cash balance. I was only taught lower limit, upper limit, and return point. Okay, this is a question which comes from students that it asking using the Miller-Orr model, calculate the target cash balance. Okay, so I was taught in the classes in Miller model upper limit, lower limit, and return point. I was not taught about the target cash balance. Okay, you were not taught about target cash balance. Leave it. You were taught upper limit, lower limit, return point. You saw the name of Miller model. Don't leave the question. Find these three: upper limit, lower limit, return point. Okay. Now, what is the lower limit? I told you it's always given. Minimum cash balance 40,000. So this is the lower limit. Upper limit, remember, lower limit plus spread, and return point, lower limit plus 1/3 spread. Okay, so I need spread here. Sir, spread had a very long formula. No worries. Click on the formula sheet. You will be given spread formula. 3/4 transaction cost variance of cash flows upon interest rate per day, power 1/3. Okay. So I will find spread via the formula. Okay. And variance of daily cash flows. Remember standard deviation square. So it's 15,000 square. Then interest rate per day. So you have been given interest rate 9% per year. So 9% per year means per day it's 0.025% per day. Okay. Now I think you should compute spread here. 3 3/4 into transaction cost, that's 55 into variance of daily cash flows. Variance of daily cash flows is 2 to 5 million divided by interest rate per day. So it's 0.00025, the interest rate per day. It's power 1/3. I'm going to sort it. So first, this will be solved. 3/4 transaction cost variance of daily cash flows divided by interest rate per day. The power 1/3. So 3/4 into transaction cost to variance of daily cash flows. Divided by interest rate per day. This whole bracket. Power 1/3 and then into 3. Okay, so let's find what spread we are getting. So 3 by 4 into transaction cost into variance of daily cash flows divided by interest rate per day. Uh, uh, Power into 3. So 100,078. Spread is coming as 100,078. Now, once you get the spread, you will get the upper limit. That's lower limit plus spread. And return point, that's lower limit plus 1/3 spread. Okay. So this is what you have computed all three things. Now, I'm going to tell you one thing, that this target cash balance is just a name or return point. This target cash balance is just a name for return point. So ideally, you were only required to find a return point in the question, nothing else. So I just said that target cash balance is just an alternate name of return point. So you were only asked to find a return point here. Okay, and for return point, it's just lower limit plus 1/3 spread. But that's the thing that your mind must be open. If you forgot that target cash balance is an alternate name of return point, don't worry. It says using the Miller-Orr model, calculate the target cash balance. At least you must know that in Miller-Orr model, three things are required: lower limit, upper limit, return point. So calculate all three. Automatically, even if you don't know what the target cash balance is, still you have computed and you will get marks. And if you remember the target cash balance is just an alternate name of return point, just calculate return point, that's it. Okay. So make sure your mind is strong. And if your mind is strong and your memory is good and you remember that target cash balance is the alternate name of return point, uh, I think that's fine. And to improve the mind, you can eat chickpeas like me. We call them chana in Urdu. So you can eat them to improve your mind as well, or to make your mind strong. Almonds also work in making mind strong. Please copy this. Okay, so I've got for 5 marks, and then 6 marks, 11, and then 14 marks. So the last requirement of this question, discuss the motives for holding cash. Now, this has been a requirement that has been tested multiple times, taught to you. Easy 6 marks. Motives, reasons for holding cash. There are 3 motives or reasons of holding cash. Transactionary motive, precautionary motive, speculative motive. Explain them to 2 marks. Cash might be required for day-to-day operations like purchase of material. If there is no cash held, company may not be able to purchase material or pay supplier on time, resulting in production issues. Or credit rating getting affected. Okay. Precautionary motive. Sometimes emergency circumstances arise, like fine, penalty, or any other emergency. Unavailability of cash may result in company not being able to handle emergency issues. Speculative motive. Remember? Sometimes. This is taught to you that transitory motive, this is the reason for holding cash, that you need cash for day-to-day operations. If you don't have cash, your operations would be disturbed. You might not be able to purchase material, not do production. Precautionary motive, that there are some precautions, some emergencies. Not holding cash may result in not handling emergencies. So you need cash for emergencies. And speculative motive, remember, investment opportunities. Cash must be kept for unforeseen investment opportunities. If you don't have cash, any investment opportunities come, you will be able to not do that. You will lose them. Sometimes investment opportunities or chance deals arise. If company is not holding cash, it may not be able to take advantage of those investment opportunities. Okay, so these are the 3 reasons of holding cash. You have completed both 20 marks question from the September-December 2024 past paper. Hope everything is clear to you. Take care. Thank you.